Hey everyone, and welcome to this explainer. Today we're tackling wealth building, but through a completely different lens. A lot of people treat getting rich like it's a lottery ticket, just hoping a perfectly timed market jump or some super lucky stock pick will do the trick. And let's be real, the financial space is incredibly noisy right now, with everybody shouting about the next big trend. But when you actually dive into the math, it turns out lasting wealth isn't about luck at all. It's really about following a strict mathematical order of operations. It's about setting up a structure where success basically becomes the only logical outcome.
Looking at the research, it is incredibly common to feel totally paralyzed by financial choices. If you've ever stared at a paycheck, or maybe a small year-end bonus, and felt this sudden wave of anxiety, asking yourself, what on earth should I do with my money? You are absolutely not alone. Should you invest it, pay down debt, save for a house, buy into that index fund everyone keeps talking about? Decision fatigue is a very real psychological barrier. And honestly, that anxiety usually stops people from starting at all. We freeze up because we're just terrified of making the wrong move.
Okay, let's dive right into this. Do you remember being in middle school and learning PEMDAS, parentheses, exponents, multiply, divide, add, subtract, right? It was this golden rule that told you exactly what part of the equation you had to solve first. If you skipped a step, you got the wrong answer, no matter how good your arithmetic was. Well, personal finance has its very own order of operations. The steps you must take to build wealth securely have a specific, non-negotiable sequence. If you try to multiply your wealth before you've added a protective baseline, the whole equation just collapses under pressure. So, phase 1, build the foundation first. This is the absolute critical step you have to take before you invest a single dime. Now, the math here actually reveals a massive shortcut. A huge mistake beginners make is trying to save 3 to 6 months of their entire income. That immediately feels completely impossible and discouraging, right? But notice that second column. The focus is purely on essential expenses. We're talking survival mode here. Things like rent, groceries, and basic utilities. We are definitely not calculating for dining out or all those streaming subscriptions. If your take-home is $35,000, your absolute bare-bone essentials might only be $22,000. Targeting that smaller, leaner number makes building a robust 3 to 6 month buffer highly achievable. It completely reframes how you look at your safety net. So where do you actually store this protective baseline? Splitting it up is highly effective. You'll want to keep 2 to 3 months of those essential expenses in a standard savings account. Why? For instant access and zero market risk. You need that money available at 2 a.m. on a Sunday if a pipe bursts in your house. The remaining 3 to 4 months, that can go into a liquid mutual fund. It might take a business day to access, but it historically offers slightly better growth to help defend your cash against the silent thief of inflation. Together, these two create the perfect, multi-layered safety net.
Now, here is the absolutely crucial point. You might be thinking, why not just start investing immediately and figure the rest out later? Well, walk through this disaster scenario with me. Imagine you eagerly invest $90,000 over 18 months, but you skip the emergency fund because you really want those stock market returns. Then, boom, a sudden medical emergency or a job loss hits, right as the broader market undergoes a 20% correction. Because you have absolutely no cash buffer to pay your rent, you are forced to redeem your investments at the absolute market bottom. You walk away with $78,500. That is an $11,500 permanent loss. Starting to invest early without an emergency fund literally destroys wealth when life happens. It forces you to sell your best assets at their worst possible price.
All right, phase 2, umbrellas, sunglasses, and allocation. Here's your blueprint for diversification. Don't put all your eggs in one basket. Yes, it's the oldest cliche in the book. Your grandparents probably repeated it 1,000 times. But looking at long-term data, it remains the absolute bedrock of asset allocation. It's the single rule that keeps your wealth growing steadily instead of wildly swinging up and down. We see it time and time again. One sector of the economy crashes while another one soars. If all your eggs are in the tech basket when a tech bubble bursts, your portfolio is completely devastated. So here's the formal definition. Diversification is the practice of spreading money among different investments to reduce risk and limit fluctuations without sacrificing too much potential gain. Basically, it means intelligently mixing stocks, bonds, real estate, and cash so that you aren't reliant on a single economic outcome. But honestly, that's a bit dry and academic. I promise there is a much easier and frankly way more fun way to visualize this exact concept. Forget staring at boring pie charts. Think of the street vendor metaphor instead. Imagine a street vendor deciding to sell both umbrellas and sunglasses at the exact same stand. At first glance, you'd think, that's a terrible business model. Nobody buys both at the exact same time.
But the vendor knows human behavior and weather patterns. When it rains, the umbrellas sell out and save the day's profits. When it's sunny out, the umbrellas collect us, sure, but the sunglasses fly off the shelf. By selling both, they completely neutralize the weather risk. As an investor, you must balance market conditions by holding different types of investments. You need financial umbrellas for the economic storms and financial sunglasses for the boom times.
Moving right along to Phase 3, the boiling point of wealth. This is the fun part, when your money actually starts working for you. 12.5x. I want you to lock this magic multiplier into your brain. It marks a massive transition in your life. Look, we spend so much of our early lives saving and feeling like we're just pushing a heavy boulder up a massive hill. But when your total investment portfolio hits 12.5 times your annual savings rate, the paradigm shifts entirely. At this point, your money officially outsaves you.
Let's run the exact math slowly just to make it super tangible. Say you're disciplined enough to save $7,000 a year. Assuming an average historical 8% annual return, once your portfolio grows to hit $87,500, the market growth alone generates over $7,000 in a single year. It essentially acts like a massive invisible employer match. The compounding accelerates your wealth completely independently of what you're contributing from your paycheck. Your money has effectively become an employee, matching your effort dollar for dollar.
Now let's hit that exact same multiplier again, 12.5x. But this time, we aren't applying it to your savings. We're going to apply it to your total income to reveal the ultimate boiling point. This is where the math goes from just matching your savings effort to entirely matching your working effort.
If you're earning $50,000 a year, 12.5 times that is a $625,000 portfolio. Look at the math. At an 8% return, a $625,000 portfolio earns $50,000 in a single year. Think about the gravity of that for a second. At this milestone, your investments are effectively generating a second full-time salary. Your portfolio doesn't sleep, it doesn't take vacations, and it definitely doesn't clock out. It is a second worker in your household earning an entire salary without you lifting a single finger. At this stage, your money is efficiently working harder than you are.
Which leads us to our final phase, reaching financial independence, the absolute summit of the financial mountain. How do you know when you finally hit that summit? Well, the historical data points us to the 4% rule. This rule basically states that when 4% of your total investment portfolio can completely cover your annual living expenses, you have reached true financial independence. Decades of historical market simulations have shown us that withdrawing an inflation-adjusted 4% a year allows a diversified portfolio to sustain itself indefinitely. Your wealth becomes entirely self-sustaining, making mandatory work completely optional. Let's break down the math step by step so you can calculate your own ultimate financial summit right now. And it's incredibly simple arithmetic, actually, because 25 is just the inverse of 4%. First, calculate your actual annual spending. Let's stick with $50,000 for our example. Next, simply multiply that spending number by 25. The result? $1,250,000. That right there is your independence target. Hitting that number means you can sustainably draw your income directly from your investments. You've officially solved the final equation.
So I'm going to leave you with this somewhat provocative question. Is your money working harder than you are? Building wealth really isn't about guessing the next big trend or getting lucky. It is a strict order of operations, just like we learned in grade school math. Take a minute today to evaluate exactly which phase you're in right now. Do you need to build that essential survival buffer? Do you need to set up your diversified vendor cart? Or are you pushing toward your boiling point? Applying this specific sequence absolutely changes the game. Thanks so much for exploring this with me on today's Explainer, and hey, keep learning.